another common challenge to the idea that stocks are expensive, and this again pertains particularly to the US, is the idea that buybacks have been a feature of US equity markets over the last couple of decades, and that this may, or the typical sort of Gordon growth model based estimates may not effectively account for this. And you do go through the Strelin-Ibison study in your book. Maybe just briefly summarize how they modified their model to account for buybacks and maybe what that implies for equity returns.
Yeah. So yeah, I think so. That's the best study on this question, that if buybacks are now sort of challenging dividends, or dividends have been replaced or augmented as a payout, how should we adjust the dividend discount model? Should it be something else than dividend yield and dividend or earnings growth or so? And they add buybacks. They create very long histories, and it really starts to matter only from 1980s onwards. But then it is also fair to say that if you include buybacks, you should sort of include the flip side of it, which is companies issuing equity. And when you think of the net of those two, it turns out that it doesn't matter nowadays so much. So the big picture today is not too important. Historically, this is related to the geeky concept of 2% dilution, that equity market sort of like the persistent issuance into equity market created sort of 2% dilution. But nowadays buybacks are so much bigger that there's pretty much a sort of, zero dilution. So I would say that right now it doesn't matter too much, but any historical analysis needs to recognize that there has been this transition towards other ways of giving payouts to investors, and you have to interpret your data much more carefully. I confess that I studied this a few years ago with my team quite a bit. We wrote about it. Ultimately, I felt that we got lots of headache-inducing topics from that, and not too much more true wisdom out of it. So it's something I do cover in the book, but I don't really encourage anybody to spend huge resources on it. I do think that relatively straightforward models still give broadly the same story, whether you look at sort of dividend yield type of approaches. Again, maybe tip them a little higher with this net buyback effects, and the other possibilities look at earning yield based approaches. So.
Yep. No, I like that. I do sympathize with some of the papers that talk about the elasticity of equity pricing, and sort of in the context of the fact that issuance typically, or often, a high proportion of issuance is in the form of stock-based compensation, and the owners of that are either forbidden to sell that immediately into the market, or they often just hoard that for ownership's sake in the company, whereas buybacks have a direct impact on flows, and there's this sort of consistent buyer of equities in the public market, and there may just be some impact based on the fact that there's not perfect elasticity of supply demand within the pricing model at the market level, and that just may at the margin cause prices to sort of systematically rise. But there hasn't been a lot written on that, but I think that's
and there are just so many angles to that. Like one intuition is that dividends are still more they're more sticky. It's easier to do buybacks because you can, you don't commit as much to doing them all the time. And then again, these are not the only things. Like some say that, okay, you should really think about the cash that's given back through acquisitions, and you should think about the debt part. And so again, I mentioned that this is sort of raises lots of headache-inducing questions, and I think I'll stop there.